kind of red and green on the screen here. The market not sure what it wants to do here. We've obviously had that big move off the bottom after that brutal first half of the year for both stocks and bonds. A lot of folks are scratching their heads saying, okay, now what? Let's check in with Jay Hatfield, CEO, founder, and portfolio manager of the Infrastructure Capital Advisors. Jay, now what?
Good morning. Thanks for having me back on. Well, it's a little bit complicated. We had been constructive on stocks heading into earnings, and we were correct that earnings are relatively strong compared to expectations. And we do think the economy is relatively strong because of pandemic tailwinds. But the negatives are an erratic Fed. We think the 2% target is arbitrary and way too low, so they're going to pursue that 2% target. They tend to focus on backward-looking indicators like employment and CPI, whereas they should be looking at the money supply, which is down 15% already this year. And then finally, the other negative is we're headed into September, which is typically a terrible month for stocks, lack of information about earnings, and then you have a closing of the buyback window. So we're relatively neutral to cautious on stocks here after this big run.
But you think, so Jay, just to go back to the beginning, you don't have a negative outlook on the economy. You think the U.S. economy, even after 2 quarters of contraction, is still in a pretty strong place.
Yeah, the key facts there, if you look back at the 11 post-World War II recessions, they all had a crash in housing and autos, but we have a pandemic recovery tailwinds in that we're at record low housing inventories, 1.2 million units versus normal 2, 87,000 new cars versus a million. So the chances of mass layoffs in those cyclical sectors are zero. And then you have strong employment because we're moving from goods, which are mostly made overseas, to services, which are all provided in the U.S. and labor intensive. So strong job market and the normal sectors that crack all-time lows for inventories.
We're
constructive about the economy.
We do see what looks like some real weakness in the tech sector, and I don't know if that's because they, overhired last year or the beginning of this year, but they're, some of the biggest companies are cutting by 10%. Some of the growthier, frothier companies cutting by 20%. A lot of them are doing hiring freezes. Is this just a sector-specific issue?
We think so. What is obviously entirely unique about this cycle is the pandemic. So during the pandemic, those were the big beneficiaries, but of course, services was getting smashed. So you're just seeing a rotation from those goods-producing companies, and also they have exposure to foreign currency. Keep in mind, almost no one focuses on the fact that the Fed has already reduced the monetary base or money supply by 15% this year, which is the biggest decline since the Great Depression. That's caused the dollar to skyrocket. So that's going to make those large-cap exporters' earnings weaker. But if you look, they're not really doing mass layoffs. They're just hiring at a slower pace. So that's not enough to derail the U.S. economy.
Jay, you've had a long and varied career on Wall Street, buy side, sell side. One of the industries that you've really focused on has been energy, global power, Morgan Stanley, and so on. What we're really starting to understand here is we've got oil pulling back yet again. Now we're at 88 and change on WTI crude. It just seems like the supply and the demand are kind of out of whack. As we make this transition to green energy, there's still a big demand for traditional energy, fossil fuels, and our good friends in Europe, boy, they're going to have a tough winter. How do you think about this economy and how it's trying to manage the transition from fossil fuels to green fuels? Seems like there's going to be some problems there.
Well, I think we've made a massive mistake by not recognizing that natural gas is a very clean fuel. It's the only efficient way to transport hydrogen, because pure hydrogen you have to cool to negative 451 degrees Fahrenheit to transport it, whereas natural gas is only 250. So the Europeans blew the energy transition by not procuring enough natural gas, which then allows you to shut down coal. In the U.S., the free market did that. That's why we're the leader in the world for reducing carbon, not because of any policy coming from the government, but just because of the economics of having excess natural gas. So, but to your point, we're relatively constructive on the oil market. We're still projecting 90 to 110. But the key factor to watch is European natural gas prices. Yep. They're trading at the equivalent of $400 a barrel of oil on a BTU basis. So that's a huge support for the market. And these China blips are usually temporary. Yep. They're pretty sticky demand in China.
Right. Yeah, it's interesting to see how this plays out. And again, we're going to be focusing on Europe this winter. It seems like it's going to be a big challenge for them. Jay Hatfield, CEO, founder, and portfolio manager at Infrastructure Capital Advisors, giving us his thoughts on these markets.